Welcome. Thanks for coming. I have two long-standing people here with me that have been with the company for a long time. Each of them, your perspective is really good. I think Alex Buening's been with us for a long time. Handles, probably 1,000 loads a week, maybe. So moves quite a bit of freight within the network. Does a lot of short haul, dry van, drop and hook. So from the perspective, you're more in that middle mile dry van market all across the lower 48. So really excited to hear your thought on what you're seeing, mostly in the Fortune 100, Fortune 500 space. Theo Mascari has been with us, hired you right out of college.
Yeah, 15 years.
So, yeah, it's been a while. So you handle mostly Fortune 100, large scale shippers, move, again, close to what Alex does a week in shipments, 800, 900 loads a week. It's refrigerated, long haul, drop and hook, a good portion drop and hook. And so seeing the two sides, your refrigerated side, I think, has been impacted more. The warehouses that you go in and out of have different loading requirements and scheduling requirements. So excited to hear what you have to say about the market. And so thanks for coming.
Thanks for having us.
Thanks for having us.
So I thought it was good because your business is mostly aligned in dry van.
Mm-hmm.
Tell us a little bit about the network, length of haul, equipment.
I would say length of haul varies. We do everything across the board from short haul, high volume shuttle to long haul cross country. But our main focus in the dry segment is the repeat contract business.
Okay. So mostly, you're probably in the low mid fours, 400 miles.
Yes. Oh, yeah.
High dense freight, but you're all over all 48, lower 48. And then your network is a little bit different, probably longer haul.
Yeah.
What percent's refrigerated?
So we're probably 65% refrigerated. Most of that length of haul is over 700, drop trailer, low lead time.
Okay.
That's kind of what we specialize in.
Okay. So the market, we've been in a weird, this is probably, I would say this is most similar to 2021. And so I kind of wanted to get what you guys have seen since the beginning of December. It felt like we came out of Thanksgiving, and this thing it hit a wall like we have not seen since the 2021 timeframe. So I'll start with you, Alex, from your team. What have you guys gone through since the beginning of December through the holiday and then into January?
Yeah, I mean, it's very common, right? Every year around holidays, we typically see some tightness. It just kind of throws the market out of calibration. But this time around this year, it was, I would say, particularly heightened, especially on the spot market pricing and the lack of capacity. As you mentioned, we saw it coming right out of Thanksgiving, maybe even you could argue coming into Thanksgiving, and it hung around quite a bit longer than what we typically see, well through January into February.
Because to that point, typically we come into Christmas, if the Christmas is midweek, shippers either oversupply coming into the holiday, and then post-holiday they'll fill up. So kind of build inventory, deplete, then rebuild that coming into January. And January is typically a little bit slower. And then February would be slow, and then back into March. And I've always, I think capacity in mid-January to, if weather's normal, is easy. And this year has been completely different. And the refrigerated side, what have you seen? What's the market been like in your space?
The market's been significantly elevated, especially in the Midwest. Probably since mid-December until now, most carriers are running Midwest to Midwest freight because the rate per mile has just gotten so high. Obviously, there were some storms that created a backlog, but you're looking at surge volumes across all food manufacturing as people are consuming more over the holidays, and storms backlogging everything just really tightened it up.
So when the holiday is midweek, you come out of holiday, do you feel like capacity dropped quite a bit during that time period, or was it a gradual, or was it just cut and done?
It dropped quickly.
Okay. Do you, if you think about markets to compare, for instance, East Coast to Midwest, so Pennsylvania, New York, back into Ohio, Indiana, what are you guys seeing on rates coming back? What traditionally in that time period would be an easy market. What are you seeing rate-wise on the refrigerated side coming back into the Midwest?
The refrigerated side, it's got to be up at least 50, 60%, if not more, from what we're experiencing. You have your seasonal produce like grapes coming through the ports, pineapples, but it has been elevated the past 2 months,
So you think 50% higher?
50% higher.
So if a lane was running at 1,000,
Yeah.
you could be spending anywhere
Yeah, you're
15 to 2,000.
yeah, easily.
I'd say we're seeing on a percentage basis virtually the same in dry van.
Okay.
Yeah.
Are you guys seeing anything on long haul currently in this market? Have you seen any change in capacity on long haul freight heading to any markets? Or are there markets in particular where long haul is harder to cover?
I would say long haul Midwest to West Coast has been the most challenging. Typically, there's a lot of folks that are looking to get out west to grab freight volumes as we're getting to the end of the year for Christmas sales. So you're looking at peak season product that needs to ship out and get to distribution centers and out to consumers. We didn't really see that this year. There wasn't quite the demand. Rates outbound California weren't what they were the past couple
So you
years.
think it was slower outbound Cali?
Correct.
Okay.
And we're struggling quite a bit on going west too. We're seeing the most impact, I should say.
So if a line haul was, call it 3,000 heading west, what are you spending now?
Every bit of 4
Okay.
or more. Yeah.
On the refrigerated side, I would imagine it's higher.
Yeah, but refrigerated fluctuates probably 35 to 37
Okay.
on the line haul.
Okay. Yeah. So just kind of touching base on markets. One of the things on produce market, I always, if it stays tight into March, mid-March, I feel like season starts, whether it's imports or whatever. When do you typically see produce freight start affecting the market? So the volume comes in, trucks go out to it. When do you traditionally start feeling that?
April, May timeframe is when it starts to take off. You have Arizona stuff coming across the border right now. You'll have Florida coming up here relatively soon. But April, May is kind of that sweet spot where things start to, go outbound California and really pick up.
I want to talk about capacity. So you guys deal daily, weekly with a lot of loads, and we've been through ups and downs. So we came in 17 when we had the storms.
This isn't the first one.
This isn't the first one. No, but this one feels a little bit different. The speed at which it came on, and then the longevity at which it came on. And we typically, the storm in 17 drove it. You had COVID in 20, which pushed 21 into the tailspin. And you had shippers in that time period shipping more on time than rather in full. So there was more out of orbit, more shipments coming in. This one, we've been in a falsely, and I say falsely, but we've had more capacity in the market than we should have had. And so looking at this one came about quick. There were storms, but what do you think? Let's talk about the capacity right now. What are you seeing from a truck? If you think about the truck market today, like how would you describe it? What are you seeing?
I think there's definitely something stronger that's underlying here beyond just holiday and snowstorm backlog. You see the bankruptcies constantly coming up. You have a lot of carriers that white-knuckled through the past few years post-COVID, especially carriers that locked into higher operating costs, high costs of equipment with very low spot market rates. And a lot of those carriers, unfortunately, are folding. There's the government policies that are, being broadcast throughout the news cycle, where they're putting their emphasis on that I think could be driving some costs too.
On the non-domiciled fleets or drivers that we're seeing this impact, from where you guys sit, do you hear much about it from day to day being in the trenches, working with trucking companies? Do you hear much about it from their perspective?
Hear it constantly. So I'll give an example. I was talking to a carrier we work with pretty regularly, and he said, look, a lot of these other carriers that have been operating are being pushed out of the market, and everyone is coming to us for the same amount of freight with a much more limited supply, and most carriers are looking for an increase in costs due to that.
Right, and I think that's an interesting point. That the fleet size matters, meaning if the fleet is, call it 50 trucks, 100 trucks, especially in the refrigerated side, if the fleets that were running that had drivers maybe that were non-domiciled, they would traditionally take spot market, high mileage freight that would move across the country or move into markets that were either unfavorable at a high rate, or they would be moving back to get more pickups on a backhaul type scenario. If the limited number of fleets that are operating left get over contacted, or they only have so many assets, and cost then all of a sudden goes through the roof.
Right.
I mean, so that's one thing that worries me a little bit on that side.
Yeah, and then there's the component too of how quickly do these carriers out in the marketplace react and add capacity to their fleets too. You see in the news the crackdown with the DOT coming down on some of these shady actors on the CDL schools.
Yeah.
Is it going to be that much more difficult to bring new drivers, new talent into the market? Then you have the equipment component too. Equipment's at all-time costs too. So how long does this drag on to where then you get fleets reacting, saying, okay, we're going to build up our fleet, the demand's there? Because the numbers point to the overall shipment volume demand is not there.
Right. And I look at cost too, the operating cost. I think the craziest thing that most people have no idea is happening right now is theft. And freight theft is at a level that I've never seen it before. And it makes you wonder if there were fleets that had MCs, had multiple MCs that are running these theft rings, which is driving up insurance cost across the nation. And so I guess from your guys' seats, do you guys deal with the theft issue, or do you have any thoughts on what's going on that front?
I do a lot of finished goods, both dry and refrigerated. I would say we have to be more careful with certain commodities than others. Like I think of your high-end bottled water, sparkling waters, items like that could be sold in convenience stores. Those are certainly targeted and a little bit more regionalized, but those are the types of shipments you have to be careful, put a dedicated option on it. You only work exclusively with one or two go-to providers, and you don't really go outside that circle.
Right.
Due to the commodities that we move, I won't go into detail there, but let's just say if you open the trailer doors to most of my shipments, probably wouldn't be worth the risk of stealing it. But we are watching these shady actors on our front because my customers are very high service, high performance intensive, and on time is a must. And not only are these shady actors when it comes to theft, are they a big problem, but also on a service standpoint, there's a very clear trend line to these, if you want to call them what they've been coined as the chameleon carriers. If they can't keep their act together on keeping their equipment up to par, up to code, to legal requirements, they're probably not going to put a lot of emphasis on getting the load there on time.
Right. And a lot of the equipment is leased.
Correct.
Where they bought high second owned tractors, but you're leasing a lot of equipment, so the cost of entry is not as great, and especially with the spot market and then the crackdown coming, it seems like it's pushing a lot of capacity out that would be taking freight that normally would have been what I call surge freight, which is excess freight from normal freight. I have an interesting. We've seen an increase in what I call standard routing guide freight, so where you're in a waterfall or you're tiered. What are you guys seeing from shippers? If you're not primary, are you seeing an influx of routing guide or waterfall freight being tendered over?
It's gone up significantly probably since the week after Thanksgiving.
Okay.
Didn't see much secondary tenders up until that point, and now seems like goes to the routing guide a couple times before shippers are putting it out to bid or going to API, because a lot of times the primary is not even there. They're taking other volume.
Okay. What are how does if a shipper's to think about or how standard routing guide freight, so waterfall freight, impacts the network, how is that a challenge to somebody? So if you don't see the freight often, then all of a sudden you get it in the height, how is that a challenge?
I would say from my experience, the true waterfall approach, where you would have anywhere from 3 to even at times you'd have 8 or 10 carriers on a waterfall, right? I don't see that as much as I did 10 years ago.
Okay. What do you mean by that?
I mean that many of my customers have a strategic approach of maybe you have an asset that can cover 40% of the volume, but doing a true ratio split instead of allowing one carrier to gobble up the freight and the advantageous low cost times and then letting it go down the waterfall and ultimately usually to the spot market
Right.
is where it would end up. And that's when you're the most exposed. It's out there in the spot market and you're completely subject and exposed to spot market pricing and peak times.
So if you take 2023, 2024, we'll just do 2024. How often would you see routing guide freight come down?
I mean, but rarely. It would get accepted by the primary.
So primary, it was a soft.
Very soft. Tender acceptance was high. Spot market was incredibly competitive, if it was even there at all.
Right. And then you contrast that to today. How often do you think?
Oh, I mean, we're seeing it. I mean, like to Theo's point, what we've been saying, I mean, we're seeing the secondary tenders come more than ever. And spot market volumes, customers where they would have maybe a dozen loads a day have over 100.
Okay. So on in the past, spot market ran, so you would go primary, you'd either ratio split it, you waterfall it, you have a primary, secondary, maybe a third, and then you would go down to manual quoting. With the advent of API coming in, how have you guys seen API change the way the market works? I mean, do you see it altering shippers' behavior? Do you see, is there any pros, cons?
I think there's certainly pros. You mentioned the routing guide piece. There's a lot of customers that I work with that utilize lower volume freight. There's no sense in having a rate on file for something that moves 10 times a year. A lot of folks are even to, twice a month. They just put it out to API rather than trying to hold someone accountable or create a routing guide for something that may ship once every 13, 14 days.
So in that instance, though, so shippers in 23, because I noticed this a lot, 23, 24, and even last year, the API, if it was 20 loads or less, 30 loads or less, would be the automatic solution. So it would go straight out. But now as you see the market go really tight in that area, are you seeing any movement back to a manual quote? Or are you seeing it still strictly stay on that API side? Or even are you seeing people say, can we put a rate on file for this to hold it in? Have you seen any of that?
Yeah, I've seen both avenues. I've seen where customers have backed away from API because carriers weren't taking it seriously, for lack of a better term to describe it.
API over rate, don't accept the freight.
Exactly. They don't take it, or hey, I gave my best crack at it and I just can't find a carrier at this rate. But on the flip side, I just had a conversation with a customer, and his strategy is to only have his best and biggest providers playing in their spot market.
API.
In API.
Okay.
And because to Theo's point, does it make sense to award out a 5-load a year lane at a contract rate? It's probably not going to be rated correctly because you don't really know when it's coming and the volume's not there to support a contract rate. So why not get a very small grouping of my best performers? They're still bidding against each other to keep the price honest, but they're going to see it through. We don't have to hold their hand on a lane and take up time to show them how to schedule, things of that nature.
Right. Do you guys see much manual quoting? You deal with mostly Fortune 100 shippers, large shippers, but do you guys see any manual quoting at all?
But we still have quite a bit of manual quoting, both through TMS avenues and from email.
Okay.
To Alex's point, it's a select few providers that the customers have chosen to work with, and it's your larger retailers that it's going inbound to, or it's a white glove, or it's a cross dock, and you can't miss a store delivery. Those are the manual types of quotes that we've seen. To your point earlier, there is some people that want to transition to lock in some new updated rates as we're coming out of winter, in hopes that there won't be this impact from storms that'll keep rates elevated. But most of those lanes are still on the spot market board.
Right. When you guys, has API changed the operations at all? When you think about how you guys interact with customers, do you see any impact in the supply chain, in routing guides at all, other than the low volume? Does it affect anything? I mean, like some I see where, like recently I've seen more say, look, we get the APIs back, but a lot of times they don't pick up. So we'll get the API, but we'll manually quote out. Depth of routing guides I think have gotten much smaller because of the freight downturn, and API was an alternate choice. Have you seen a giant increase in the past 8 weeks in API activity?
Certain markets, yes, we've seen a huge increase. If I look at Southwest Missouri, if I look at Kansas City, if I look at Minnesota, so really central U.S., upper Midwest, there's been a lot of API activity, Pennsylvania, New York as well. I would say those are where we've seen the largest impact of API pricing.
Yeah, it's interesting. I noticed our API count grew drastically in January. I mean, drastically. So just the people requesting API quotes. But it's weird, in February, we've seen a decrease. And I don't know if that's people securing alternative, like locking in shorter term deals on freight, because it's kind of weird. You think with the tightness that we're seeing this month, especially to start the month, you would see just it skyrocket, but it's weird. It's been down. And I don't know if you guys are seeing that, but to me, it feels that way.
I think it's probably likely the latter. I mean, how much, 'cause this has been going on since Thanksgiving, and each week up until now, it's just gotten progressively worse week by week. And by worse, I mean the spot market pricing. So how long do you ride that train until you say, okay, we got to stop the bleeding, let's put a cap on this? And you've got carriers coming to you with a solution for that. Because if you see your costs keep going up on the lane when it goes to spot market or API, week after week, going up 5% each week, eventually you're going to end with a very high number. So I think you're going to have a bigger appetite when you have a provider say, hey, give me a rate that makes it work. And that, in return, those loads are no longer going to the market.
You guys sit and deal with large shippers. You guys are majority contract freight. So you do kind of our specialty has been contract, drop trailer, high volume. When a shipper looks at a lane and says, if I was going to draw it up perfectly to contract out, so we're going to lock in a rate, we're going to put it in for 12 months or 6 months, whatever they choose. What attributes do you guys look at in a lane that say, I can contract, I can build a carrier base that's going to beat market, it won't go to the spot market? What are things that you look for in a lane that make it desirable to contract?
I mean, I would say for me, like, what's the volume on a monthly basis? And if it's consistent and it's not really heavy in 1 or 2 months of the year, you can contract it with a carrier, and you can kind of guarantee the business to be there for them. Now, if it's heavy in 2 of the 12 months of the year, then you're going to have to price accordingly, because you're going to have to go to market or get a seasonal carrier in place, which is usually during peak season. I would say monthly volume is probably the biggest indicator over an average weekly.
Is there a amount that helps? So like a lot of shippers will say 30 or 50, I'm not going to contract it. I've seen that number start to shrink down closer to 20 or 10, but is there a number that you feel like volume-wise is good?
I think over 130 a year is usually, gets you close to 3 a week. Can be a little busier during peak season, but I think the closer to 3 a week, the easier it is to contract to a carrier and have them commit.
Sure. Your stuff's a little bit short. I mean, it's high burst.
Yeah, and just looking at the ideal lanes to contract, it really varies. If like my customers, for instance, in peak times, which tend to be the warmer months of the year, that's when they're selling the most volume. So they will have other facilities provide support, production support.
So out of orbit shipments.
Yeah, and so do you contract that out and give the carrier the data saying, hey, this is mostly going to run April through September.
Yeah.
And it's not even guaranteed it's running weekly or even monthly, for that matter. The high volume drop trailer, that's an obvious one to me. But you still have to look at the requirements of the lane too. I was looking at a lane yesterday for a customer, and it's about 120 miles, 5 loads a day, Monday through Friday, and then on the weekend, they want to ship about 10 loads Saturday, 10 loads Sunday.
So steady and then heavy.
Yeah, yeah. 3 loads a day, Monday through Friday, and then 8 to 10 Saturday, Sunday.
To stock up going into the week.
But what you have to take into account is the amount of trailers you need to support those weekends, which, it does inflate the cost because those trailers are not being utilized. Now, if it was 8 to 10 loads a day, it would virtually have no impact because on a 120-mile run, you're making that more efficient for the carrier to get 2 runs in a day.
Right. So in that instance, it's the volume could say 20 a week, but really it's 20 in 2 days and sprinkle in the rest of the week.
Got to peel the onion back and get the full picture.
We're seeing a lot of bids come out. I mean, we're seeing more mini bids. We're seeing back to maybe even paring down. We had a lot of people come to us in November and December and say, let's lock in 12-month pricing. And before, during 22, 23, 24, they were saying, let's go to 3-month. Then it went to 6-month. And they would still go back to the 6 or 3-month to constantly be looking at lowering rates. When you guys look at RFPs that come back at you today, and you think about information that comes across, so you said something about seasonality, the volume count, what is it that from a shipper standpoint would lead to better accuracy on pricing? What data points would you like to see that, hey, make this pricing more legit or stable?
This is probably my 13 years, my least favorite time to price bids right now. I think that's what we're saying.
I think a lot of bids come over and it says, here's the lane, zip to zip. We'll get 5 to 5. And I think back in the day, sometimes you do people do state to state or point to market. And I think those pricing strategies are very difficult because you're pricing for the deadhead on the unknown. But one of the things that I see that I think is the most difficult is aggregate volume in the time period. So if the time period is 12 months, it'll say it's 130 loads in 12 months. It doesn't tell me what it is in March. It doesn't tell me what it is in April. When you guys look at something like that, the aggregate volume versus the monthly volume, does that affect pricing?
I think it certainly does. I think more so than that is what are the shipper and consignee, what are their hours? If you're an evening delivery, short or middle mile, your options are to run something straight through. So if it's not someone that's domiciled within that 30-mile radius of the consignee, then you've got to pay someone to be out on the road for the night. That's going to inflate your cost. And if you can't get drop trailers for an evening delivery, it's less desirable. So there's certain things that limit the carrier pool that's willing to run that type of freight. I would say that's the biggest. I mean, who is it delivering to? If you're not a shipper or receiver of choice, if your dwell times are long, you're just eating the clock. If you're a live load, live unload, I think those are the real cost impacts that you're going to see in a lane. From my business that I do, we don't have these open shipping, open receivings. It's all strict appointment. You might have to pick up at 6 a.m. one day and deliver the next day at 8 p.m. and it's a 250-mile run, but that's what you have to do.
We did an interesting analysis once. We took a warehouse that we were shipping out of, and the 2 warehouses were about 50 miles apart, not even that far. And one took about 5 to 7 hours to load, and the other one took about an hour and a half. And they went to the same market. So one location into a location was about a 300-mile run, and we compared cost. And the cost was substantially different over time, meaning cost to pay the carrier, on the one that took over 3 hours.
Oh, yeah.
And it was the equal volume, same receiver, but the behavior was so different. And I think when you get into tight markets, shipper behavior is really critical. And same with unloading, because to your point, they talk. And so if carriers or drivers understand who's inefficient, I'm not going there. I can make way more money on the road somewhere else.
Right.
So
Yeah, I mean, knowing that info ahead of time or while pricing is critical, because we have to present it properly to a carrier. Every shipper deals with facilities. Maybe it's their own, or it's a vendor or an end customer facilities that we'll call them imperfect. But business still has to be done. The loads still have to go in and out of these facilities. But if we're not equipped and we don't really understand the full picture, we're not going to do a good enough job preparing the carrier for this and set them up for success with the proper expectations. And when you don't do that, you're likely just going to have carrier churn and a revolving door of carriers until you can really prep them to what to expect. If they don't price it right, they're going to back out.
Do you, when you guys look at high volume lanes that you guys have where volume fluctuates up, so you were steady, you had one, say Monday, Tuesday, Wednesday, Friday, it was steady, and then the volume goes from 1 a day to 10 a day. So you have lanes that peak, the average peaks at the end of the week or the end of the month. What happens to cost when you guys have lanes that wildly swing, have volume fluctuations? When you guys go out to secure capacity, what really happens to cost?
More times than not, it will inflate the cost because you either have to go to secondary carriers within your carrier base or go to the market for coverage. I've got several lanes that come to mind here where usually there are 6 to 7 loads a day, right? But then on rare occasions, it'll be upwards of 25, and that's a pretty big swing. And it's important that I have the proper discussions with that customer saying, hey, share the forecast with me. If I know it's coming, I can better prepare. I can start, but if I get the tenders 2 days in advance, my options are a little bit more constrained and limited.
You guys both deal with supply chains that have seasonality. They have bursts based on time of the year, based on day of the week at times. There's holiday pre-build that has to go along. And I think in particular, you also deal with some low lead time. And I think it's important around here, we watch lead time quite a bit because lead time is one of the biggest impacts to cost. What happens when you get a tender less than 48 or 24 hours to pick up to your cost? So if you have 4 days or more versus the low lead time, in the market in the past 2 months, what's happened to that cost?
Oh, it goes up significantly. I mean, probably 15 to 20% at a minimum, which is a huge impact, especially on long haul freight. I mentioned some of the ideal volumes being a few times a week, but it's dependent on length of haul. How quickly can you get a truck back from Midwest to California? Like, it's not like they're coming back next day. You got to wait a week to kind of have those carriers cycle back through. So the routing guide strategy you build in those scenarios, the low lead time really hurts on cost. You almost need a fluctuation
Spot market. You almost
right. Yeah, you have to go to market unless you have a base of 7 carriers in rotation.
Yeah. How about you guys? I mean, I know that your tender day can be pushed to the end of the week, and then most manufacturing starts on Sunday or early Monday, 3 or 4 in the morning on Monday. So how does that impact you guys' cost?
I would say we see the biggest impact, and we just dealt with this yesterday, with a large unexpected amount of long haul freight. So we got hit at the end of the day. I've got to have, I think it was 14 teams on this lane. It was a lane that was about 1,600 miles. Yeah. And the challenge there, I mean, there's the obvious caveat of the low lead time, and most carriers, or trucks, I should say, at 4:30 have already found their load commitments for that evening. But when you're for long haul, and it's happening more and more. Earlier we were talking about long haul, and there's almost 2 separate carrier demographics, or 2 or more. You have long haul carriers that are accustomed to doing that and willing to do it, and then you've got regionalized and local. And the regionalized and local guys, there's not much interest these days going long haul.
And that's the cost.
Not how they're geared towards it.
Yeah. I mean, they price for the unknown.
Right.
And that's kind of one of the things that I'm most worried about is if this non-domiciled shrinks out, say there's 200,000 drivers, that number's been thrown out, that leave the market, let's just say. You also have DOT Enforcement Week, which is coming in May. So you really have this period between, because we're almost to March, then you get into season in April, and then you're off running in produce season. The long haul pressure, especially if it's tight, and you have more out of orbit shipping in the summer, and you have more produce and things moving, which increase that length of haul. The pressure on the few that do it is going to be, it could drive rates significantly if it stays in the path that it's at. I mean, so certainly something that I think we've got to watch, now, because it is interesting to watch what's going on there.
Yeah.
Are there markets in the country that aren't really affected?
Okay, California hasn't been quite as impacted. Southern Nevada, parts of Arizona.
But those heat up.
Yeah, so this is slower season for them, so that's historical. It is a lot slower in California than in past years. That's for certain.
It's like west of Colorado.
Right.
It's pretty quiet.
Mm-hmm.
Yeah.
Do you guys see bid frequency changing right now? Do you see more?
Seen a lot more mini bids. There's been a lot more inquiries about interest in putting in 30-day rates, just to get through the winter and then reevaluate after that, because many primaries turn lanes in. Secondaries aren't accepting, and they're trying to avoid the spot market, like Alex had mentioned earlier, just kind of stop the bleeding. All of my customers have kept a formalized RFP process, though, for their annual RFPs. And nothing's changed in that schedule. No one's going from a 6 to 12 month or 12 to 6. Everyone's sticking with their long-term plan. But there is a lot of mini bids for replacement carriers if service isn't there.
I mean, we're seeing mini bids on a weekly basis now, and not just randomized mini bids. I've seen now multiple mini bids that have followed just weeks after a 12-year bid award has gone out because carriers not coming through on their bid awards.
Yeah, it's kind of interesting. If you did a bid in November, December, rates back. If you got rates back, if you did a bid in November, December, and then go live was January, February, that market seems to have really affected what tender acceptance is. I've never seen more, because in some markets the rate's up 40%. It's different, like vastly different. Are you seeing that from shippers?
Yeah, I mean, I don't have any RFPs that have started in that time frame, but I can certainly tell, Central States, Iowa, I think it's been severely impacted. Those rates.
Missouri.
Yeah, Missouri in particular. That those two states, we've seen the biggest fluctuation in terms of rate per mile, and it's going any direction. It's not just those states to Midwest or to a less desirable market going into like Southeast or West Coast because it's slower. It is, you name the direction, it is the rate is increased.
Yeah, I think the biggest thing for us has been seeing the refrigerated market, and the change in the short haul, especially off the Northeast. I mean, Northeast is expensive.
Right.
Tremendously.
Which is
From
never-
what you typically see in February, it's I would not be surprised if there's certain corridors that are nearly double right now in the spot market of what you'd see this time last year.
So as we come to the end here, what do you think from a pricing standpoint? What's the rest of the year look like? I know there's a lot of people that opine and say this is what's going to happen, but do you guys have any thoughts on what's going to happen?
I think rates are going to go up. I don't think they're going to go up to as high as what a lot of folks are speculating online. But there's certainly an increase going to happen, likely in the higher single digits. I don't think we're going to see large double-digit increases. There's certainly, due to the expense of operating equipment, I think rates are due to increase. There's no way around that, especially with the cost of insurance. Carriers are going to have to raise rates. But there's a lot of what ifs. If Illinois has to pull 1 in 5 CDLs that were issued, that's a problem. That's one of the largest manufacturing states.
Yeah.
That would be a massive impact to the industry if that were to happen.
There is no slow season the next several years if that happens.
Right.
I think to kind of further build on that, there's a lot of unknowns. And I think the current administration is making it very clear they're pushing forward with this stuff.
Yeah.
We're seeing it now. As that continues on, it's only going to further drive more drivers out of the market. And then we're going to get to where carriers are going to have to hire drivers, and then they're going to have to pay drivers more to incentivize them to get into a truck. We're going to have some members of the workforce that haven't driven a truck before jump into transportation and into professional driving. Even if you remove those factors, if I had to put a wager on it, I'd say this year's probably going to be quite a bit tighter than what we've seen the last few years.
Yeah, it'll be interesting to watch. I mean, I think overall the general economy is good. There are, I think the divergent path will be supply of trucks. You know, it makes you appreciate well-operated, well-run trucking companies that have been here and established and hire professional drivers. They do a great job. We see them every single day. But for the first time, that focus on supply, really look at that tail freight, the spot market freight that was the ones that shippers had moved out to API. It may go back down to more lower and more contract, and then watching routing guide compliance, because overloading primaries with freight is going to become trucking companies price multiple shippers in the same market, and they move to ones that favor the best use of their equipment, most efficient use of their equipment, and then advantageous to their fleet and driver network. So if pressure comes this year and drivers exit, it is going to be a pressure year, and rates will change. And this event could be something that's worth watching, but at the same time, we are seeing some of the stuff move back down to normal, and so as the snow melts and the southeast cleans up, I think we could see some stabilization in markets and lanes and areas, but it will be dependent on what happens with the supply side. So,
Yeah.
well, thanks for coming.
Thanks for having me.
Yeah.
Thank you.